Today, I'm going to show you some of the most common pitfalls when it comes to write-offs that people think they can take, but they actually can't. And what happens when the IRS actually catches you. Let's get into it. What's up, guys? Mike back at it again, CPA, co-founder and partner of Ledgerly, alongside my partner, Andrew D'Amico, where we've helped hundreds of business owners just like yourself clean up their books after they made some pretty bad decisions. So today we're going to be going case by case, myth by myth, showing you what people think they can actually write off, but can't, and what the IRS might do if you get caught in the action. Hit that subscribe button. Let's dive in. Okay, myth number one, gym memberships. What people think, I need it to stay healthy. I got to keep the juices flowing, the blood pumping. My gym membership is a business expense. Wrongo. Gym memberships are generally not tax deductible. For the most part, physical fitness is a personal benefit. And the IRS says maintaining your physical health are personal expenses. Now, there's some rare exceptions, right? Are you a fitness influencer? Are you a personal trainer? Okay, then yes, now we have a valid business expense, a valid business argument. And there are also workarounds when it comes to medical conditions with health reimbursement arrangements, or maybe some cafeteria plans. But for the most part, not deductible, especially for someone like myself. I'm an accountant. But what happens if you wrote it off anyways? Let's say a $1,200 gym membership at 37% tax rate, about $440. Now that's going to get added back at $440 plus penalties and interest. We might be looking at $500-600 people that you have to add back and owe back to the IRS. Let's not make stupid decisions here. Okay, myth number two, business clothing. I bought these suits. They're for client meetings. Oh, they're a business expense. Well, I just saw you wearing the same suit at your cousin's wedding, or just saw you at Aunt Donnie's funeral in that same suit as well. They're not exclusively for business purposes, sorry. The actual rule is clothing is not deductible unless it meets the IRS's requirements. And that requirement is the uniform test. They are required for you to perform your work, and they're not everyday leisure wear. Like for nurses, scrubs, hard hat for construction, gloves, steel-toed boots, not things that you're just going to wear out to the supermarket. Now, there is an exception to clothing, right? I'm going to take my hat off. You can see my bald head, right? I got my Ledgerly branded hat. Now, this is not clothing expense. This is marketing and advertising. That's different. If we really wanted to, I can buy a whole slew of these and sell these online. But the moral of the story is advertising and marketing, clothing, and uniforms are all different. Okay, that's clothing. Myth number three, commuting to your regular office. Most people think, oh, I drive to my office every day. That's commuting mileage. No, wrongo. Commuting from your home to your regular place of business is not deductible. Anything in excess would be deductible. Your home to a client site, your office to a client site, your client to client. Your regular office commute is not deductible. Now, if your home office, like my home office, serves as your principal place of business, then you don't have a regular commute. So then in that case, home office to client, fully deductible. So this is where we got to be careful. This is where we got to be smart. And this is where we're talking about the mileage method. Are we tracking our miles? If not, then we need to calculate the percentage that we are actually using our personal vehicle for business use. And if that's the case, then we got to tally up all our gas, our repairs, our insurance, all of the costs of maintaining the vehicle, not just the mileage percentage. So either make sure that we're tracking those expenses in a spreadsheet, or if we're tracking our mileage, there's some great apps for this thing right here on your phone. So commuting, mileage, be careful. Myth number four, I love this one, 100% of your cell phone. All right, I'm going to fully speak off the cuff here. If you have one of these bad boys and you are claiming the entire thing as a business expense, then I got to question your well-being. You're working 24/7. You're on the phone 24/7. How would you talk to your mom or your dad or your brother or your sister or your family members? That ain't going to fly in the IRS's eyes. But if you have two of these bad boys, now we can say this is 100%. And then we can go back and say, okay, well, actually, there were a couple calls that I had on this. So maybe 20% business use on this, 100% on this. Now we have an argument. So be careful with the cell phones. Focus on the things that are going to take your business to the next level, generate revenue, and are ordinary and necessary for your business. But what if it's too late? What if the IRS picks your name out of a hat and you're getting audited? Well, they're most likely auditing your return for some common triggers. Round numbers, $2,000, not $2,001, or inflated expenses, especially for the industry. Remember, the IRS knows where your NAICS code is. They're comparing that to other businesses in your industry. So if this is you, be prepared to open up your file cabinet and give them all the documentation, the receipts, the backup, the documentation. Because once they disallow all those other expenses, your gym membership, your 100% cell phone, those clothing expenses, they're going to add that back to your income. There's going to be additional tax on top of that, plus penalties, plus interest. Let's be smart. All right, so after we're done watching this video, after we're through this whole kit and caboodle, step one, let's review our deductions that we took last year. Are they ordinary? Are they necessary? Do I actually qualify for these? Do I have documentation? Could I justify this in front of an auditor in the event of an audit? If the answer is no, stop deducting it. Step two, clean up your current year. Let's set your table. If you've been writing off the gym, those clothes, 100% cell phone, just stop, reevaluate. Let's go back to the drawing board and deduct only what you qualify for. Step three, let's make sure we have our proper tracking in order. Whether we're using an iPhone app for our mileage, we got QuickBooks in order, we got an accountable plan spreadsheet. Let's make sure we have that off the books documentation. Number four, work with a good accountant. Let's work with a straight accountant, not a crooked accountant, because most likely that crooked accountant ain't going to represent you in court. Find someone that will. Number five, for the love of God, please stop following TikTok advice, because 99% of the time it ain't going to work, and it's just an invitation to an IRS audit. Moral of the story is the IRS is very clear about what's deductible and what's not deductible. If you just want help audit-proofing your return or a second set of eyes at your books, click the link below. Let's get in touch. Let's have a phone call. And if this video saved you from a future audit, make sure you hit the like button, comment, subscribe, get in touch, and steer clear of all that stuff that you're questioning that might get you in trouble. We'll see you on the next video, everyone. Take care.